The idea of becoming your own banker, banking on yourself, and utilizing life insurance as a banking alternative is becoming more and more popular. With banks like the SVB failing and all this information saying that up to 180 more banks are on the precipice of failing, I think a lot of people are looking for viable alternatives. You look at the history of whole life insurance companies, the fact that they've been proven to have a track record of success in weathering all the financial storms that have happened for the past 180 years, it's no wonder that this idea has become more and more popularized. So that said, how do you utilize your life insurance policy as a bank? Is it even really a bank? And what are the things that you need to consider? Those are the things we're going to talk about in this video. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Let's go. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, we're going to be talking about how to use life insurance as your own bank. And is it even possible? So ultimately, obviously, there's a lot of people, in my channel included, that talk about infinite banking, that talk about the idea of utilizing your life insurance policy to be a banking alternative, to take control of the banking function in your life. If you listen to all these infinite banking people out there, that's kind of what they talk about all the time. So what does that mean? What does it look like? And let's just take a look and see what it looks like on an illustration. And I want to walk you through kind of some things to look at, to contemplate, to consider on the illustrations themselves, so you can really think about what is the purpose of this. Now, before I get into this, what I do want to say is this. Your life insurance policy is never a pure bank account, right? So I want to make sure that's abundantly clear, because it's not how it works. You're not going to have checks for your bank, right? You're not going to have checks with your life insurance policy, I should say. The whole concept of becoming your own banker and taking over the banking function in your life has to do more with cash flow and how you manage that cash flow and how you manage major transactions in your life. And rather you paying interest to the bank, how do you recapture as much of that interest as possible? That's what it's all about. And so in this video, what I'm going to do is I'm going to kind of go through the banking alternative, why you need it, the purpose that you want the bank to play in your life, the purpose that you want the money that you have sitting in a bank account to play in your life, and ultimately how you can leverage it to perform multiple functions in your life, how you can get each dollar leverage. I think that's one of my favorite parts about utilizing a whole life insurance policy as a banking alternative, is that you're getting each dollar perform multiple duties for you. And because of that, that is a form of leverage, right? I think a lot of people think of leverage as a really negative thing because leverage increases exposure, leverage increases risk. Think about real estate. If I buy a real estate property cash and I'm cash flowing that property, even if the market goes down, even if the building goes unoccupied and I lose cash flow for a period of time, I can weather that and I can fill people back in it. And because I don't have a lot of overhead and I'm not leveraged on the property, if the account value goes down, I don't have to worry about things if I don't have any leverage, if I don't have any loans against it. But when it comes to life insurance, it creates more leverage because we have to think about what do we need our money to do for us. And a lot of times people are just thinking too short-sighted. And I think a lot of infinite banking people even just think too much about the numbers, think too much about the spreadsheets, and they discount the value that the life insurance contract has for people, right? The benefit of the actual death benefit, the benefit of the living benefits, the benefit of each dollar solving different problems at different phases of your life. Now, I did a video I think a couple weeks ago now, talking about the different things whole life insurance does for you at different phases of your life. And I'll put a link right up here. I'll just try to connect it up there. And you can go check it out if you want, maybe check it out after the video. But the bottom line is whole life insurance will solve different problems at different phases of your life. So I want to go through this a little bit. And I want to talk about what does this look like and how should your expectations and use of a policy be as you go through it, thinking about it as a banking alternative, and what other things does it solve for you? What other problems or challenges does it solve for you? So let's just go here, and I am going to look up at my top monitor here where I have all this. And so this is an example. I'm going to zoom in a little bit for everybody here so we can see a little tighter. There we go. So you can see what I did was I did a $1,000 a month premium, 12,000 bucks a year. And you can see here that that leads to year one when we talk about leverage. Well, the downside of a whole life contract is when you're utilizing it as a banking alternative is that apples to apples compared to a bank account, you're not going to be where you want to be in the sense of liquidity. So what I encourage people to think about is like, why do you need this money? And so if you need money in a bank account for liquidity purposes, don't overstretch yourself. You don't want to put too much money in the contract where you don't have enough liquidity in an actual bank account that you need from a month-to-month basis. I'm not a big believer, not a believer at all, in fact, that you should pay your monthly expenses through your life insurance policy. There are certainly some advanced strategies that you can utilize that maybe can take advantage of that by utilizing credit cards and other lines of credits and things of that nature. That's not the purpose of this video. I want to keep it really, really simple. Now, you can see here, we put in 12,000, we got 8,300 bucks liquid. You know, this is a traditional policy. We could do some things with this to make it better or worse, but because of the fact that we're looking to maximize the long-term benefits, not just the short-term benefits, but the long-term benefits. I know a lot of people are going to say, why don't we just do a 1090 policy? It's because of the long-term benefits, the lifetime benefits, the living benefits of the policy that I care about, that I need this to perform multiple functions, right? And so I wanna have a policy that kind of gets me the best of all worlds, right? And so by giving up a little liquidity on the front end, you know, we have 8,300 bucks out of the 12,000 we contributed. I'm okay with that, right? Like I would be okay with that. And if you needed more money, keep it in a bank account. Don't stretch yourself too thin. Don't make the premiums so big that you can't manage them. Now, that gets us a $243,000 death benefit right out of the gate. Now, as you can see, $12,000 a year goes in and the policy goes up by $18,000 the next year, or the policy goes up by $10,547. So we're still losing a little bit every year because it's going into expenses and fees, and it's covering insurance charges. And the way that whole life works is that the insurance charges are higher on the front end, but you can also see that even though we contributed $12,000 more in cash value and the policy went up by $10,000 in value, that the death benefit went up even more because of the paid up additions, and paid up additions are paid up additional insurance. So that's not creating more fees, it's creating more cash efficiency, and actual death benefit is paid for. So that's important to understand. Now, some other key points that I want to point out here is as you're utilizing this bank account, what you have is this money is completely liquid, right? So what is the purpose of this? Why do we want this money? Well, the first thing that we're looking for is I'm a big believer that financial structure is extremely important. So the first thing that we want to do before we go invest and take on risk is we want to build our financial foundation. We want to eliminate risk off the table. We want to position ourselves to be better investors. And the only way you do that is by positioning yourself to have a financial foundation of stability on a guaranteed product that is liquid. There's not another product that will do for you what this will do in that context. And that's why I love this so much, right? So if you believe in that and you believe, hey, I need an emergency fund, well, imagine you and your spouse have $100,000 a year of income and you say, I need 6 months of emergency fund. Well, you can see here that you have paid $60,000 in cumulative premium by year 5. Well, now you have your 6 months of savings. You're still behind a little bit because you only have $54,000 of net cash value, but look at the benefit that you have. You basically, what does that mean? For $6,000 of a loss of liquidity over that time, you've got $338,000 of death benefit. That's pretty, when we talk about leverage, that's what I'm talking about, right? $6,000 for $338,000 of death benefit, right? 6,000 bucks is pretty sweet, right? Like when you think about it. Now, the other thing I want to show you here is starting in year 5, this is when the policy becomes more efficient than a bank account. What do I mean? Efficiency in this context, or what I'm talking about right now, is for every dollar I put in, right? You can see year 4, I put in 12,000, it grows by 11,871. By the time I hit year 5, I put in 12,000 and it's growing on a net basis by more than I'm contributing year in, year out. And this is where it gets powerful. So when people say, hey, Chris, how much do I want to contribute? And why would I want to keep continuing to do this, or why wouldn't I just stop, right? I think when you realize this, you're investing in a long-term strategy, and you're committed to this long-term strategy and system. And in doing so, what happens is you realize, I should say, that year 6 you put in 12 and it grows by 13.5. Year 10 you put in 12, it grows by 16.2. Right? It gets better and better and better. So if the bulk of your fees and the inefficiency of this contract, i.e., it's not growing by more than you're contributing, is all year 1 through 4. Well, when we look at this, if I showed you this contract and I showed you year 5 and beyond, right? Anything below this year 5, and I said, hey, you can contribute 12,000, you're going to get a death benefit. It's going to grow by more than you're contributing, and your net cash value is going to keep growing, and there's really no downside. Well, then who in the world wouldn't do that? Every single person would do that. That's just leverage. Each dollar is performing multiple functions. It's getting you liquidity, which you need. It's getting you more growth than you're putting in, which is going to beat inflation long term, which is what you need. And it gets you a death benefit, which is what you need. Or maybe you don't need it, but I promise you, you want it from a tax efficiency perspective, because this death benefit, there's a reason why wealthy people own more life insurance than any other segment of the population, is because they understand the value of tax-free passing on of your legacy, right? Like that is extremely, extremely powerful. If every single family in the world owned one of these policies and set up their financial structure like this, the whole world would be a completely different place as far as a person's relationship with money and financial literacy and their ability to have self-accountability to an extreme level, right? And so you can see here, by year 20, check this out. I just want to point out a couple things. We've contributed $240,000 in this, and you have $338,000 of liquidity with a $785,000 death benefit. It's pretty powerful stuff. Now, full transparency, because I know a lot of these Dave Ramsey fans are going to be saying, well, you don't keep the cash value and the death benefit, you only keep the death benefit. Well, that is true in this case. The reason they do that is because if you were to save this if you were to go buy a $243,000 death benefit, which is what we started with, and save the money in a bank account, first of all, if you save $240 in a bank account, you wouldn't have $338,000, you'd have less, but it would also be taxable. Because they include it in the death benefit here, it goes passed to the next generation tax-free. Now, the other thing here is if you subtract 785 minus 338, what is that? That's like $437,000, something like that. And so when you look at that, $447,000 actually, when you look at that, that's more, $447,000 is more than the initial death benefit that you paid for. So that's one of the biggest flaws in Dave Ramsey's argument when it comes to not liking whole life insurance. Because when he complains about whole life insurance from a traditional structure where it's all base and it's not utilizing paid up additions, it's not designed properly, and so that's something to take into consideration. And so we're getting our dollars to perform multiple functions and solve multiple different needs. So each dollar, that is a form of leverage. Now let's do this. Let's go down. I want to go down to, well, let's talk about this here. You can see by age 75, when it's fully paid up, you've put in $367,000 and you got 1.16 million with $463,000, for 1.463 million of life insurance. It's pretty powerful. So what I want to do now is I want to go through and I want to get down here. I want to get to this place right here and look at the supplemental illustration for the accelerated death benefit plus report, right? So let's take a look at this. This is powerful stuff. What this is showing is that we have living benefits. Now, if you're like me, I share this story a lot, but I am not a believer in Western world medicine. Big. I mean, I believe that it absolutely has its place, and it certainly has helped save plenty of lives, but I think the world of cancer treatment and chemotherapy and radiation is overused, and I think, unfortunately, while those can work in some situations, I think for the most part, our bodies are extremely powerful, and we have the ability to heal ourselves in ways that insurance, like if we had the ability to cover the expenses, more people would be open to it, but a lot of it is subdued. A lot of it is because insurance companies won't pay for it because I think of the manipulation by pharmaceutical companies and all that stuff. I think it's just one of those things where if people had access to capital, their mind would open up. And if you had the freedom, and if you said, hey, imagine you got to a place where you needed a treatment and you had cancer or something of that nature, and you had the ability to say, listen, money's not an object. I just want to treat myself. I want to cure myself. I want to give myself the best chance to heal. If money wasn't an object, what would I do, right? Thinking outside of the box. And that is what I call controlling your medical directive while you're alive, right? Like, and really getting after it, and you really thinking proactively. And so granted, it doesn't really matter. Like, I mean, I got a 31-year-old here. And what this shows is if you get diagnosed with a terminal illness, right? If you get diagnosed with a terminal illness, you have access to $88,000 while you're alive in a lump sum to pay for medical treatments. Now, obviously, if you just started and you got approved for life insurance and you pass a medical exam and all that, the odds of this happening are very slim, very slim. But let's get down to the times when it's a little bit more likely that it may happen. 55 years old, you get diagnosed with some sort of cancer. You have access to $654,000 of a lump sum payment to have tax-free money in the form of a benefit to treat yourself and handle and use it for any kind of medical treatment or whatever you want, quite frankly. I mean, I had a client way back in the day when I first started that utilized the living benefit like this to take family on vacation, because by the time they diagnosed stage 4 pancreatic cancer, she didn't want to fight it. It was too bad, and she just wanted to enjoy a month traveling the world with her family. And she took a big lump sum and used her life insurance a little bit while she was alive, because rather than just giving money, she wanted to live and experience and enjoy her family, right? Like, that was a big deal. So that's a big thing. So you can see this number goes up and up and up as we get older. You can see by the time you hit 68 years old, you can access up to, now you don't have to take all $1 million here, but you could access up to $1,032,000 while you're alive. And that's powerful stuff. Now, that's just the terminal. If you become chronically ill, and this is a funny thing, a lot of people, when it comes to Index Universal Life, and they talk about it, first of all, you can't utilize Index Universal Life as a banking alternative. And secondly, a lot of Index Universal Life agents, one of their biggest arguments against whole life is that whole life doesn't have living benefits, and they've been basically lied to by the people that are training them, because look at this, chronic value. If you become chronically ill and you can't perform 2 of 6 daily living things, or you're cognitively impaired, then you can have access to this. So you can see, you can either get periodic payments of this column, or you can get a lump sum. I'll focus on the lump sum. You could get access if you're chronically ill for $466,000 when you're 50 years old. By the time you hit 65, if you become chronically ill, you got $860,000. You can see the number for chronic is a little less than terminal, but the bottom line is these are things that we're going to have to deal with at some point in time. Chances are we're going to get sick. If we, unfortunately, the rate of Americans, especially getting cancer in this country, is just, it's mind-numbing how likely it is that we're all going to get cancer because of the toxicity in the environments that we just live in and spend our times in, right? And so because of that, and we know we're going to do this, the question that I have for you is, how are you going to manage that? Now, if I did a 1090 policy, what would happen is the access to all these numbers would be far, far less, because the access to these numbers, to the accelerated benefits, are not based on the term rider that allows you to dump the cash in. It's based on the base of the premium. So if this is important to you, you know, you have to think about from a short and long-term perspective, you know, a 90-10 policy, a 1090 policy might get you an extra $2,000 or $3,000 liquidity year one, but if it costs you access to hundreds of thousands of dollars in retirement for medical treatment and for that flexibility, it's like you can't solve long-term problems with short-term thinking. Is it worth it for you? If I asked you today, if you would give up liquidity of $2,000 right here, maybe $2,500, for the chance that you'd potentially have a couple $100,000 more in retirement in case to help cover your medical expenses should you get cancer, should you want that flexibility, would you be willing to do that? I think most people would say yes, right? But like, This is the challenge that I have, and I gotta switch this over here. Sorry. This is the challenge that I have. Everybody that's pitching these 1090 policies, they're just looking at life on a spreadsheet, right? They're looking at it from this perspective of, look, dollars in, dollars out, X's, O's, dollars, cents, whatever, you gotta go this way. You don't buy life insurance just for that, right? Like if you're buying it just for the cash value, you're missing the point entirely. You're buying it because you should be putting your money into it and buying the policy and saving in it because of the leverage that it gives you, because of you're utilizing it as a banking alternative on steroids, right? And you can see the flexibility of the cash value there, but and the growth of the cash value, how it's going to beat your bank and how you can utilize it in all these different ways. You obviously always want to keep enough money in your bank account so you have short-term, like within 24-hour access of the liquidity that you need to live life, or you need to make sure you live life with credit cards and manage them properly. But the bottom line is when we look at just the dollars and cents, a 1090 policy, the first 10 years of a life insurance contract is gonna win every single time, hands down, against a 40-60 policy, for instance. I think one of the things that isn't talked about enough is this concept of what are our challenges and our problems gonna be later in life. And if you wait to deal with these issues until you have to deal with them, until they become an overt issue, then you're gonna have bigger problems. You're gonna have bigger challenges. You have to deal with, if you deal with them way ahead of time, like right now, like this situation as a 30-year-old on the illustration that I just did, then you're putting yourself in a situation where you're reducing the challenges, you're reducing the exposure, and you're getting more leverage out of every dollar that you put into a contract, right? So once again, I'm gonna reiterate, if I could show you that you could not even lose money, but just lose liquidity, right? Lose the liquidity, the access to $2,500 in the first year. Maybe over the first couple years, you're a little behind, but it gave you hundreds of thousands of dollars more of flexibility in case you became chronically or terminally ill while you were in retirement. Would you be willing to give up that access? And I think most people, the answer is yes, but unfortunately, too many people are focused on the 1090 factor of it, the cash value, and only focusing on that. But you gotta look at the long-term element of it. Especially, I always kind of tell people, you gotta align your money with your values and beliefs. If you are a believer in a more natural way of healing, if you wanna have that flexibility, if you wanna have that control, what do we talk about? We talk about control. I'm obsessed with control. And I'm obsessed with controlling our own money. That's why I don't like 401ks. That's why I like having it here, investing in real estate and doing things like that. But I'm obsessed with control of controlling my life. By me having money in this policy and having higher base, giving me more access, the more money that I have in my chronic and terminal illness component of this policy, the more control I have over my medical directive, the more control I have how I show up on the back end of my life. And the less of a burden I know I will ever be on my family. I don't know about you, but when I think about aligning my money with my values and beliefs, that's a huge value and belief that I think is extremely important, that people, because we don't think long enough term, they miss the ball on. And so I really want to encourage everybody to think about how to use whole life insurance as a banking alternative today, but think about what your needs are from a long-term perspective. And when you really break it down, I think what you're going to find is 1090 policies have a place. We help people with them from time to time. But for the most part, what I find is if we really have a conversation where we don't look at an illustration, if we have a conversation where we just talk about you, your lifetime goals and objectives, your values, your beliefs, what you want to accomplish, what you want a product, a financial tool, what problems you want that to solve for you, I promise you, when you think deeper, you're going to think beyond just the X's and O's, the dollars and cents of the ledger, right? Because it's more than that. And yes, everything has a cost. You may have a shorter term liquidity crunch, right? And you're gonna have to balance all that in, but think long term, think about leverage, think about all the problems that this product, this financial tool can solve in your life. And I think it'll have a huge impact on how you decide to design a policy for yourself. And if you are interested in working with somebody that can help you, that can really just get beyond like all the noise about the money side of it and the ledger, because that's important, but it's got to be about aligning the policy with what you are truly looking to accomplish, then you can set up a free clarity call down in the description below the video here. Talk to one of the coaches on my team and connect. And we literally, it's not a sales call. It's a clarity call to help you understand what this can look like in your life. They will help you. They will guide you. And I think that's really important. I don't believe in pressure sales. I believe in educating and guiding people through their own path of discovery. And I think good things happen that way. And that way you can come to a place where you truly, truly believe in whatever financial strategy that you are implementing, because that's the only time you're gonna really grab control and take radical self-accountability for the results in your own life. And that's why I love this. It forces us to become more so we can live the life that we want to live. So anyway, hopefully that makes sense. If you have any questions, comment in the comment section below. If you haven't already, make sure you subscribe and hit the bell. That way you're notified every time I launch a new video. Until next time, have a blessed, inspirational day. We'll talk soon. See ya.